This is a market right now that is really sort of looking at what's going on in Washington for a wide variety of reasons. But more importantly, they're really trying to figure out kind of not only the trajectory of economic growth, but the trajectory of inflation here. Are you worried right now about some of the price pressures that we're starting to see?
Well, I think as the economy reopens and we had supply chain issues, I think there will be fits and starts in the inflation data. But we're not concerned about inflation continuing, and we think that it will probably peter out by the end of this year, early into 2022. We don't think that inflation is a sustainable trend. We don't think we're going to have runaway inflation at all.
Well, that might be a reason why we're seeing the market kind of in this holding pattern here, despite the fact that we've had some relatively benign days here the last few weeks. The market is still relatively camped out near those all-time highs, at least for the S&P 500 here. When we talk about the health of this bull market and the ability for this bull market to sort of move into a different gear and go even higher here, how confident are you in that?
Well, I think the bull market is still intact. Earnings for the first quarter came in better than estimates. Earnings for the second quarter, we think, will come in better than estimates as well. Remember that companies have learned how to generate revenue with a lot less resources, with a great deal more productivity. And that really isn't going away. I think that productivity will build. I think that will be reflected in share prices. And I think the market does indeed move higher. We're constructive on the market going forward for the intermediate term for the balance of the year.
Terri, the market from a broad brush perspective, is it just go long S&P 500 from an index perspective, or do you need to find your pockets at the moment? Can big tech, for example, continue to push higher if we do have, more healthy readings, shall we call it, on the inflation side?
Well, certainly tech isn't going away. It's underperformed so far this year. We think the areas of outperformance will be in the sectors of energy, financials, and industrials. Energy, we think, will do well because of the reopening trade and because of the increased demand. Financials will do well because of the grind higher in interest rates. And industrials will do well because of the infrastructure plan coming out of the White House. So those are the areas that we're encouraging clients to focus on right now.
Of course, also coming out of the White House to afford this fiscal spending is taxes to go up to a certain extent. We've been talking about capital gains taxes. That's going to affect some of your clients, but also corporate taxes too. How are you seeing that within the market and the potential to hold it back or not?
Well, certainly the news that comes out of Washington can add volatility to the market and give investors pause. But I think that the market can absorb tax increases if they do come through from the White House. We've had tax increases in our history before, and the market moves on. And I think we can absorb these tax increases as well, as long as they're not too aggressive.
So we're entering an era now where a lot of people are starting to look for some sort of normalization with regards to monetary policy, Terri. And obviously that starts with some sort of tapering and I guess eventually at some point interest rates coming off the floor here. Do you think the Fed is going to move faster than what the street right now has priced in?
Well, the Fed has certainly admitted that they are closer to pulling support from the market than they have been in the past, and they're talking about it. But talking about it doesn't mean that they're going to be doing anything right now. I think they will be very measured in their message to the market. They will choreograph this very, very carefully and be very transparent with what they do. They want no surprises, no mistakes with this market going forward with whatever they do with interest rates.
Have you been relatively, comforted, for lack of a better word, by the communication that we've been getting out of the Fed members?
So far, the Fed has been communicating their intentions pretty clearly. I don't think they want any missteps at all. And I think that the yield on the 10-year is really telling us that they're comfortable, the market is comfortable with that communication.
Interesting. So could we get any more bouts of volatility in the 10-year, do you think, in borrowing costs in general from a sovereign perspective?
Oh, there is no doubt that volatility can lurk and be very surprising on all aspects of the market, not just with interest rates, but with equity prices as well. But overall, we think that interest rates will grind somewhat higher. Again, the market can absorb that. And we think that the bull market is still intact and that the market does move higher as well. We can live in a world with higher interest rates as well as higher stock prices.